So it's been a while since I've answered this question, but it's starting to pop up with younger people. What are ETFs? These are exchange traded funds. Weiser was a pioneer in the usage of ETFs back in 2004 when we started building all ETF portfolios. We definitely saw that as the way of the future, and it's certainly here. We see all ETF portfolios built in many different firms. So why use ETFs over other options like mutual funds or individual stocks? First of all, an ETF is created a little differently. It trades like a stock. So that's where the exchange part and the name comes from. So an ETF, exchange traded fund, trades like a stock in that it has a bid and an ask, just like you would in the stock market on like Coca-Cola or GE or Delta Airlines. But when you buy the ETF, you buy a share of the ETF, you're getting its underlying holdings, meaning that you own, if you buy VOO, which is Vanguard's S&P 500 ETF, you own 500 companies in that one share or fractional of a share. So that's really good for diversification. Unlike its predecessor, the mutual fund, if you own a VOO in a brokerage account, we don't expect you to get unwanted capital gains. An unwanted capital gain is when you hold the stock, you didn't sell anything, but the stock has typically, or the fund has 7% turnover. So the ETF, let's say it has, the S&P changes which companies are inside the ETF. That's about a 7% turnover on average every year. And what would happen is the gains from them selling those different stocks would pass through to the shareholder in a mutual fund. In an ETF, the creation and redemption process is unique in that that does not happen or should not happen. Now, there are ETFs that do pass through capital gains, but typically not the core ETFs like large cap US or mid cap or small cap or the US aggregate bond index. Those typically have never passed through unwanted capital gains to the investor. So that's one of the reasons why you'd want ETFs inside your portfolio. Another reason is liquidity. You don't have to wait till 4 p.m. to be able to trade the fund. It happens instantaneously during normal market hours. In some cases, you can trade ETFs even after hours or in pre-market trading. So it provides more liquidity. Also, if you wanted to do option contracts on larger ETFs like SPY, that has a large derivative market where you can do calls and puts. We don't do that as a firm, but that is something that's available. The ETF in general used to be just your core asset classes, but now you can buy ETFs focused on sectors. So if you just want to buy financials, or if you just want to buy technology, or if you want to focus on a fund that only buys foreign holdings, all those can be done with ETFs. So you can build your own very customized investment portfolio using exchange traded funds. Now, the last part of this, and I'll keep it brief, they really should be called exchange traded products, ETPs. They do that in Europe. We don't really call them that here in the US, but exchange traded products simply because not all ETFs are the same. Some ETFs, you own the underlying asset. So if the ETF company goes out of business, for example, Vanguard and the S&P 500, you still own all 500 companies even though you bought it inside the ETF wrapper. Now, in some cases where we have exchange traded notes, ETNs, you don't actually own anything. So what that means is if the ETN went out of business, then you would actually get absolutely nothing. This happened during Lehman Brothers collapse back in 2008. So I would probably stay away from ETNs, but focus on exchange traded funds that own the underlying assets, which is the majority of funds. Also, exchange traded funds, ETFs, for the most part have been passive, meaning that they're built to mimic an index. In some cases, people created indexes for ETFs to mimic, making them a little more active. So in our firm here, we use a fund called COWZ in some of our portfolios. It focuses on the top 100 companies of the Russell 1000 that have the most free cash flow. Well, that's a really active strategy. So what's happening is every quarter that fund is resetting. There's also mutual funds that have abandoned, mutual fund managers that have abandoned the mutual fund platform, and they now have ETFs that trade in and out of stocks every day, just like the mutual funds did. So just because it's an exchange traded fund doesn't mean it's the best for you. You have to understand the methodology of the ETF, who creates it, and why it exists. And once you understand that, you can then add it to your portfolio if you think it's in your best interest to do so.
A great place to learn more about ETFs is actually ETF.com. Many years ago, maybe back when I had hair, I spoke at some of their conferences when they used to be called Inside ETFs, and they have now since evolved to ETF.com. So you can go to ETF.com and then put a /, put the ticker that you want to learn more about, like ETF.com/VOO, and you can get a breakdown of that fund or any ETF. Thanks for watching. If you want to learn more, always reach out.